Hi, my name is Alex Maddox. I'm the Capital Markets and Digital Director for Kensington Mortgages. I'm going to spend a few minutes here running through the outlook for the UK macroeconomic environment and give you our views of what could happen over the rest of 2022. So what we've seen so far is a rapid drop in GDP and then pick up again, and the same really has been coming through with unemployment. So what we've seen is unemployment picked up, as you can see from the chart on the top right-hand side. Obviously, lots of concerns during the COVID crisis, but then unemployment has dropped down quite rapidly, which I guess is a good sign for everyone in the country. And you can see there the claimant count monthly, which are the small blue bars, also reducing and being in negative territory for quite a period. So I think the important thing is, what is the Bank of England thinking? And as you'll see in a few slides, that's what's going to drive their rate decisions. But the Bank of England has now said it expects unemployment to fall to around 4%, and that is actually lower than they've been predicting previously. And I think you're going to hear that story a lot as we talk about the macroeconomic outlook, that it basically is better than everyone has been predicting. Their previous prediction of 4.5% now down to 4%. And we've also obviously got the point there you can see in the fourth bullet point that Brexit has also been compounding this, because there have been fewer migrant workers coming into the country as well. I guess it remains to be seen what happens at the end of the coronavirus job retention scheme. But again, I think everyone is now feeling very positive, and the recent sort of Omicron variant has really not, had a huge not had a huge impact that people were concerned about. Moving on to GDP, as I was talking about, we've seen this big drop and then a pickup. And I think the interesting thing there is the dotted green line you can see on the UK GDP annual growth, and this is the Office for Budget Responsibility, the government's entity, and you can see there that they expect quite a quick reversal from negative back up to positive as the economy got back on track, and then to stabilise between 2 and 4% going forward. And you can see that historical trend more recently in the quarterly numbers, because the annual numbers obviously do only refresh once a year. So I've shown you the quarterly numbers there on the right-hand chart, so you can see that very rapid recovery in GDP, which I guess we've all been seeing when we've been out of the shops and talking to people in other businesses across the UK. But you can see that the actual move down of negative 10% was very extreme. But the bounce back luckily has been just as strong. When I look at UK inflation and house prices, obviously key for all of us in the mortgage industry, let's look at inflation first. And obviously this is usually very closely linked to wage inflation as well, which is important for our customers, and the combination of wage inflation and price inflation driving the affordability of most mortgage customers. You can see here that the CPI index, is, you see the top right there, as 5%, or really some of the all-time highs. That last time that index was above 5%, it was back in 2011, so over a decade ago. And I think again here, what we should say is that the Bank of England's expectations of inflation have been gradually increasing. And one of the, I guess, the key questions everyone has is whether this increase in inflation is going to be transitory, so something that's going to disappear naturally in the next year or so, or whether it's going to hang around for longer. And then why that's important is with respect to what interest rates need to do, because if consumers and businesses and investors and ultimately the central bank think that inflation is going to remain high for a very long period, then there's going to be much more pressure on the central bank to control that through higher interest rates, as I'm sure you're all aware. When we look at house prices, also we continue to see a very strong market. You can see how almost all of those lines have been stable from 2017 to 2020, but then really all of them since sort of middle of 2020 have seen a nice pickup. The northeast doing pretty well in terms of that pickup since, as I say, since mid 2020. So overall, house prices and house price inflation has been pretty strong throughout this whole period. Mortgage approvals, if you look at the chart on the right-hand side, and I show here usually number of mortgage approvals in order to remove the impact of house prices going up. I think a lot of the time we see people talking about the value of mortgages every year, and of course it's important, but it can be that the value of mortgages goes up just because the value of houses goes up. But you can see here in terms of mortgage approvals, if we look at, I think the sales volume, for instance, for properties in blue, you can see how that flatlined really from 2017 through 2020. And mortgage approvals pretty much over the same period sort of bounced up and down according to typical seasonal moves that all of you in the intermediate industry will be very, very aware of. Then you can see obviously in early 2020 we had that drop in mortgage approvals, but it has come back. Stamp duty and other changes really did help us get mortgage approvals back on track. But again, we seem to be landing, I think, in a similar kind of number of approvals per year as we had during that 2017 to 2020. So I think personal view is that any increase in mortgage lending volumes will probably be driven more by house price appreciation than more mortgages going through the market. So I guess the question everyone has is, what does this mean for swaps and mortgage rates and central bank rates? Because this ultimately will be driving the prices you see from lenders like ourselves. So we have this table in the bottom left-hand side there, which I think is very important in terms of the forecast. But maybe before we move to the forecast, just a quick look at the charts on the right-hand side. So if we look at the top chart, this is swap rates. Swap rates against SONIA. As you'll all be aware, typically swaps used to be quoted against LIBOR, but with LIBOR ceasing to exist at the end of December last year, the swap market now quotes against SONIA, or sometimes the term SONIA rate, and you'll see that term being used, I think, a lot more going forward. And the SONIA very, very closely tracks the Bank of England base rate, so you can think of SONIA as being equal to the base rate in the first order. And you can see here how swap rates if we look at the green line for 2-year swaps have been around 0.8%, dropped significantly as we were coming into the crisis as a result of Brexit, dropped even further as a result of the COVID crisis, but then have started to increase. And you can see that rapid increase in the fourth quarter of 2021 as that green line sort of almost goes vertical in sort of September, October. And that was driven by those expectations of inflation that I was talking about a little earlier. And you can see there that swaps now are back up to that 0.8, or actually even higher now, more like 1.1% for the 2-year swap rate. And you can see that across what we call the whole maturity curve, so 2 years, 5 years old, 10-year swaps, all of these rates have started to go back up again. But I think what's quite interesting is you can see that the rates are fairly equivalent for all those different maturities. And when I talk about the forecast in a minute, what you'll see that means is that we're expecting rates to go up, but then stay quite stable for quite a long period. One thing to show in the bottom right-hand chart, where again I've got the swaps spread there, you can see that increasing. We've also got credit spreads for securitization market, which is where many mortgage lenders, but especially Kensington, raises funds. And for us, the combination of the swap rate and the AAA spreads is what matters. And the good news is that yes, swaps are going up, but credit spreads or AAA RMBS spreads are staying low. They were under a little bit of pressure in the fourth quarter last year, but certainly the initial indications this year is that the securitization market is going to be pretty stable throughout the year ahead. So I guess the takeaway from that is that it's going to be swaps that are driving mortgage pricing going forward, and less driven by credit spreads in the securitization. So now if we turn to that table in the bottom left-hand corner, you can see what the market is forecasting for the Bank of England base rate in a month's time at 0.4%, and then increasing out into 12 months' time, expecting it to be 1.24%, but then actually staying there for that even out to 2 years, the market's forecasting the base rate will still be 1.25%. So what's planned here, I guess, is that in order to control inflation, the central bank is, the market thinks the central bank is going to increase rates up to about 1.25% and then hold them there for quite a significant period. And actually, if we look at forecasts even beyond 2 years, it doesn't go up much further than that. If we look at the 2-year fixed rate, which is used to price 2-year mortgage products, a lot of that pricing has already moved up. So as I said, 2-year fixed rate or 2-year swaps are at 1.1%, and they're only expected to increase to 1.2% over the 2-year horizon, and a similar kind of outlook for 5-year swaps. Actually, they're predicted to stay the same or even go down a little bit over this period. So, yeah, I think a lot of the movement in the interest rate market has already been built in. The market is expecting rate increases, and so the question here, I guess, is really, is this what's going to actually play out? But if it does, what we're seeing in the interest rate market probably means the mortgage rates are not going to increase unless lenders have to increase margins. I think the one challenge to the outlook for mortgage rates is that we've seen quite a steep increase in in swap rates in the fourth quarter, as you can see from that top right chart, yet mortgage rates haven't had an equivalent move upwards, which I think it's going to be interesting to see how lenders react in the first quarter of this year. But if we assume they continue to target margins where they are, then it could be that we're seeing quite a stable outlook for rates in the year ahead. But I would again come back and caution everyone, it's all going to be driven by everyone's expectations of inflation over the next 12 months. And I will be watching the inflation numbers very, very closely as we move through the year. So with that, I will hand you back.